What's up, gold miners? Today we welcome Chris Prefontaine to the program. Chris is a creative financing expert and the founder of Smart Real Estate Coach, a real estate coaching platform that teaches others how to do real estate deals without using personal cash, credit, or banks. After losing everything in the '08 crash, Chris was able to overcome that adversity and build a massive real estate portfolio using only the creative financing strategies that we discuss in today's episode. He now uses that same knowledge to coach students in over 80 markets across the country. And in this episode, we dive deep into some of these creative financing strategies so that you can learn how to replicate Chris's success. We kick off the episode with Chris going in depth on the various deal structures that he uses to acquire real estate, including owner financing, subject to, and lease purchase options. Later on in the episode, we get into the weeds of Chris's 3 payday system. He teaches us how anyone can use this system to get paid 3 times on any real estate deal: upfront, monthly, and upon exit. And finally, we conclude the episode with Chris giving us his interpretation of what's happening right now in the residential sector and how anyone who uses the strategies that he teaches can take advantage of the current market conditions today. Chris is a master of creative financing, so if that is something that is interesting and appealing to you and you want to learn more, this is the episode for you. So without further ado, everyone, let's welcome to the program, Chris Prefontaine.
The Gold Mine Podcast.
Chris, welcome to the Gold Mine.
Thanks, buddy. Glad to be here.
Yeah, excited to chat. I see you got your Wicked Smart shirt on.
You got it. And you had the right accent. Where are you from?
I'm from Silicon Valley, baby.
All right. Well, you did it. You did the smart right. So that's good.
Smart. Yeah. I've seen enough movies, right? I've watched The Town a few times.
Good. You practiced
too. Yeah, man. So I'm excited to chat with you today. I mean, you've got some creative financing background. I've had a few different creative finance guys on, but walk me through how you got your start. I see you did some sub 2 stuff, lease purchase and whatnot. So kind of curious how you grew your portfolio and how that all began.
Well, I've been at it for 34 years, Danny. So what I won't go 34 years. We'll put the audience to sleep. But what I'll tell you is what sparked the creative piece of my career was the '08 crash. So going into the crash, I had 23 projects or so going on, whether it was raise the roof or condominium conversion or mixed use, whatever. And they all got crushed. And on every single one of those, I was on personally on the loans. So coming out of that, I had to make some decisions. If I'm going to get back in the trenches after I got mentally and financially beat up, what are the rules going to be? And they were things like, okay, no more gobs of my own money, no more signing on bank loans to this day, and no more transactional deals only. In other words, in 34 years, I made good money with transactional deals, but you're on a treadmill, potentially, or they're a treadmill. So we trademarked the 3 paydays, which we may get to in the show, may not, but it's a way to get paid now, get paid over time, and get paid long term per deal. So it's a different quality of income. So that's how we kind of landed here. It started out me doing deals, then organically, Smart Real Estate Coach kind of came about because people were asking for help. And then that grew into, with hitting 5,000 now 3 years in a row for fastest growing companies. We get in the trenches and do deals with peeps. That's what we do. We don't just sell stuff. So that's the big differentiator.
Yeah, that makes sense. And transactional, it's interesting that you say that because I do feel like that. I do feel like a lot of people kind of, I'm from the residential real estate space. So that's where I got my start before getting into hotels. And on the residential side of things, I do see like a lot of transactional behavior, and like these flippers, right? Like there are a lot of flippers in my area. Mm-hmm. I'm like, dude, if you just did like, 20% of the volume, but bird everything and held on to it, they'd be worth 10x what they're worth today. So it's interesting that you came to that realization too, where like, you can make money once or money in perpetuity, and you chose the perpetuity. So kind of walk me through what those like structures look like for you today. Like, what does a typical investment structure look like?
For as far as today goes, I'll talk about how we exit and then it gets more advanced, but I'll give you the baseline. How we buy is 3 ways coming out of the crash and still to this day. Today I'm in a different spot, but I still practice the same thing. Owner financing with free and clear properties, number 1. Doesn't matter the asset class, just free and clear, because about a third of the properties in the United States are free and clear. That's a great pond to fish in because they're not stressed. They want top dollar, but they'll give you the term. That's who we deal with. And 98% of the deals, we're doing principal only payments to the seller. So that's a major kind of recession hedge when you're whacking down principal. There are properties you have to have imputed interest, but most of the ones we live with under $1 million, primary residence, you don't have to have any interest. Second way we buy is subject to existing financing. You can go out and grab amazing homes right now and other assets with rates under 5%, 2%, 3%, 4%. And then the last way we buy, we don't buy, we control, is lease purchase. Those are 3 ways we enter a deal, regardless of the asset class. Now I teach single families out of the gate because I don't want to give everybody shiny object syndrome. And a lot of our people are brand new. So they start with that, but you can do any asset class after that.
Right. That's okay. So you're going to have to walk me through this a principal only payment structure. Sure. Who's falling for this stuff, right? Like who's saying, no interest-free loan to you, sir. So how does that work?
Well, there's a number of reasons they do it. Number one, they want their price. Number two, they don't want to be reporting interest income. They'd rather get a premium price and do capital gains, right, over time. And number three, estate planning reasons. Like I bought my own building that we had our companies in, and the gentleman had literally a 4x8 sheet of plywood for sale by owner financing. And he said, Chris, they don't get it. I got brokers coming in there offering me, cash offers or financed offers. He said, I don't want it. I need to make sure I have this over installment sale. And then he was willing to do that over time. This was no like newbie. This guy's like one of the largest landowners on island here. I live on an island. So as long as you can solve what they're trying to solve or create a goal that the market won't give them, then they'll do it and they'll give you a term. I got a 20-year term on that. So picture, you do hotels and whatnot. Picture underwriting on a commercial building, 35% or at least 25% down, in the microscope everywhere you don't want them to look. Instead of just, I cut the deal in 20 minutes, half hour, a couple of visits, and then it goes to the journeys, boom, close in 30 days. So dramatically different.
Mm-hmm. Yeah. I mean, there's no bank, very little friction, right? I'm assuming there. So that's really interesting, man. I'm assuming that you are paying top dollar, right? So you're probably overpaying, quote unquote, overpaying for the property, but in terms of your monthly payments, it's probably lower than would it be with the interest tacked onto a lower price property. Yeah.
Okay. So good point with the overpay. So we can either pay market value or thereabouts, which is typical, or if they'll go out longer, I might add, if they go out, say an extra year per year, they'll add, I might add another 2 or 3 months worth of my principal pay down. So if my payment to them is $1,000 a month, just making that up. And they say, I'll go out 3 more years because instead of 5, I'll do 8. Okay, I might add $9,000 to the price. What do I care? In 9 months out of the 3 years he gave me, I'm eating that up. And they win and I win. So that's how we kind of navigate around that.
I see. And so at the end of the term, has the principal been completely paid down at that point, or is there like a balloon at that point?
Yeah, not typical balloon. Yeah. So on our residentials, that's being cashed out by our rent-owned buyer we put in there who just needed time. On the commercial or income properties, then we're just selling it off or refinancing it. Typical selling it off.
Understood. So how are you identifying these owners? I'm assuming you have some tools, whatnot, right? So for that, you say, we're just going to look for everyone who owns free and clear. And you're, I'm assuming, sending them some sort of marketing letter or like how are you typically reaching out to these folks?
We actually use virtual assistants to dial and sometimes we'll mail. I'm not big on mailings only because when I started after the crash, I was just broke. I mean, I couldn't mail anything. I was a bank, I couldn't mail anything. So I go big on the phone. So we have virtual assistants doing those initial dials. But do we sprinkle in mailings? Yeah, but I'm talking like 300 to 500 pieces a month, not 5,000-10,000 a month, right? Small stuff.
Gotcha.
Niche. So on your list question, we'll go, give me free and clear owners, give me free and clear owners that live out of state, give me free and clear owners that live out of state that are also delinquent on taxes. There's all kinds of, unless you're in Canada, which is tough with data. United States, you can buy a list for anything these days. Yeah, anything.
Yeah, the data's out there. It's always funny, like when someone says like, how did you get my number? Or how did you get my contact information? It's like, the internet? Like, it's all out there.
Well, we ask for the mortgage info and they'll go, I don't know why that's important. I'm not going to give you that. I go, okay, it's public knowledge. I was just trying to save some time. You can get in these days.
Yeah, I know. It's crazy, man. So that's really interesting. And, okay, so sub 2. Now, obviously, sub 2 has been super popularized over the last couple of years. And that I have a couple of reasons why I personally am not a huge fan of sub 2. First one being, the lender can always call it, right? Have you had any of your students, or have you ever had any issues with like the lenders calling the note or finding out that there's been a transfer of ownership and then, calling it?
Yeah. Biggest question. Okay. So a couple of answers that are super important based on that comment and question. One is, no, I haven't in 34 years, but can it happen to someone? Sure. If it's not papered properly, because, you said, well, they can call it. They can't call it if it's done properly, meaning the St. Germain Act was put out in 1982 to allow personal, you could personally transfer your property to, say, family members in a trust for family and estate planning reasons. That negates the due on sale clause. When you paper it properly in a trust that includes the seller, you won't get a call. Now, here's a case study for you. This just happened. One of our attorneys, we've got them all over the country now, we're in 80 markets. One of our attorneys in Florida, Charles, had one of his investor clients, not in my community, but he brought it to our event last year in Boston. He did have a bank come after him, and he hired Charles to try the case, and Charles beat the bank. Why? Because he had it papered properly in the right trust with the owners being protected. Super, super important case study for the whole investor world, by the way. And that was just like 2 years ago that happened. So we owe a lot to Charles. But people won't know, but for years, that'll be a win for investors.
So, and the other thing too is subject to, right? Like, it seems to be something that could work really well in this kind of market where the rates are higher, right, than they were a few years ago. But like in a market, say, where the roles are reversed, right? Like, let's say 5 years from now, where rates are maybe at like the low fives, and people bought in like the sixes or the sevens. Suddenly that strategy just doesn't really make sense anymore, right? Because like, why do a sub 2 with the higher rate?
If you were basing it on just that 100%, but when you base it on, I can give you scenario after scenario, but so we bought one, I don't know, now it's probably 7 or 8 years ago. We kept this one. We didn't do the exit, but they were in a divorce. And so life events happen, right? And because of that, we walked into about 90 grand of equity. So I didn't care what the rate was. Now it happened to be like high fives. It was decent, but I wouldn't care if it was in the sevens as long as I was walking into 90 grand of equity. And also the payment worked in the rent-own world. So it's all relative. You got to look at the deal holistically. Our 3 paydays are like 45 grand to 350 grand, all 3 paydays per deal. So you got to look at the whole picture. I could lose money on that monthly payment, $200 a month, $2 grand a year, if my all 3 paydays were 100 grand, right? So you just got to look at the deal holistically.
I see what you're saying. Okay. That makes sense to me. And the other thing too is like everything that you just talked about, right? All 3 really can be used for commercial 100%. Real estate as well.
Yeah.
Right. Yep. So Chris, have you personally done any deals outside of like just the residential sector? Have you used these strategies on larger buildings?
Mixed use, commercial, like my own office building I told you I bought. That was a mixed use on they call it $1 Million Mile on a super busy highway. And then I pointedly mail, Danny, to 4 to 20 unit buildings because it's not a crowded space. And I mail only to those that are free and clear. The last 2 I did was a 6 and a 4, both no money down, both principal only payments. One was, I'll give you the reasoning. So people go, wow, how do you convince these people? One guy had 2 girls in college. He entered the market for $459. He couldn't sell it. He just wanted closure before the next season started, and he wanted cash flow. Simple. It was a 4-year term, short. The other guy, his dad built the 6 unit, and he was living in it, but he traveled to Canada a lot for business. He's like, oh, look, I'll be your eyes and ears even, but I just can't own it. I'm not here. So we did no money down, monthly payments to him, and we took over. So he was closure for him. That solved his problem. Now, that's not everybody. That's what we seek out.
Sure.
Do you need 10 of those a month at how profitable they are for us? No. Most people I teach around the country in these 80 markets we're talking about need a handful of those. They can leave their job. So it's a big deal.
Right.
Profitable.
Yeah, no, that makes sense. I mean, sure. There's so many different scenarios out there. Like, for example, that scenario with the guy with the daughters in college. My assumption is like those monthlies that you're paying him now probably covers the majority of their tuition.
Or whatever he needs it for. Yeah, within that tuition situation. Yeah, or housing or whatever. Yep.
Yeah, that's very interesting. That's very, very interesting. Switching gears a little bit, Chris, because I read something here that was like super interesting about your financing strategies, in particular the 3 payday system, right? So talk to us about how you coach your students to earn 3 distinct paydays from one deal.
Yeah, so the 3 paydays would not apply to the income properties or the commercial and mixed use, right? That apply to more the residential, whether it's 1, 2, or 4, whatever units. And that is on the rent to own. So we've had a major, United States anyway, a major uptick in people leaving W-2 to go start their own biz. And in doing that, you get multiple 6-figure earners that leave their job, they start a business, they walk in the bank, and they can't get financing. They're not financeable for at least 2 years. I heard it's getting worse, but 2 years of seasoning they need, right? New business. Or they leave their job, they get a new job, 2 years of seasoning. These guys are able to go through our rent to own program, walk in a house, and have home ownership with a mortgage ready plan in 2 years. Okay, so where do the paydays come from? Payday 1 is they have a down payment. They thought they were going to go buy. They're just not financeable yet. That averages for us anywhere between 25 and 40 grand, depending on the size of the price of the house. Payday 2, I'm paying something to you as a seller. They're paying me something higher. That delta is mine every month. So I got a check now, transactional piece. I launch a cash flow stream. And then in 3, 4, 5 years, whatever the term fits for their mortgage ready plan, then we have the cash out. The cash out is all the principal pay down that we accumulated based on those strategies in any markup. So those 3 paydays are what I meant when I said we range between 45 low to 350 grand, new record last year, the community per deal, all 3 paydays. Those are super lucrative.
Yeah. So walk me through the upfront one again.
That's a non-refundable down payment from the buyer. So they got to come in just like they would, like if you and I are going to buy a house today, we're going to put a down payment. We're going to close in 45 days, let's say. Right. They put a payment down now. They can't close for 2 years or 3 years, depending on what the screening tells us, the underwriting. But in the meantime, they have a rent-to-own vehicle. The deposit's already funded. They're committing to buy that. It's not an option. Sure. They're committing to buy it.
Got it. So as the seller, so you're saying as the owner of the property, that's the 3 payday system, correct?
As the investor, whether I bought it, owner financing, sub 2, or I control at least purchase, I'm capturing those 3 paydays.
Gotcha. So as the controller, as the investor in the deal, you're talking about a rent-to-own system, basically, correct. Right? Yeah. Where you're collecting a deposit up front. There's arbitrage during the lease period. And then on the sale, obviously, you're getting paid as well, right?
Yeah.
Hopefully. Yeah.
Yeah. Well, I'll tell you the default rate, 2 to 10% is a default because we're super strict. My son has been with me since 14 and he runs the buyer side. Yeah. I'll tell you that podcast after podcast, you can go find it publicly, which kills me. There are plenty of people in my space that do it incorrectly, in my opinion, morally and ethically anyway. And they don't care if the buyer gets qualified. They don't care if the buyer cashes out because they'll just put another buyer and collect another payday 1. Yeah. Well, that might be good legally for them, but it's bogus morally and ethically, right? So we look to cash them out, and that's one of our big values in the community. Yeah,
I mean, in fact, they'd rather they default, correct. Right? A lot of these guys,
they say it publicly, which I can't even believe it, but they do.
It is crazy. Yeah, I've heard a few people say that actually, and I'm like, really?
You don't even have to say the names. People know who they are. It's okay.
Yeah. That's funny. Cool, man. Well, that's really interesting. From a seller perspective, right? Because obviously, like these conversations tend to range, right? But all in all, like, how do you typically approach these sellers, right? Like, what would you say that the standard approach is?
After the virtual assistant calls them and sees if they're remotely open, like even a pulse for, have someone tell me more. We're calling, the investor's calling, right? Now, obviously, we have scripts. So my main thing I want to know if I'm calling you is, just like I would talk to you if you were my neighbor, where are you going? How soon? That tells me the motivation. And what if that doesn't happen? That's key. Because they all go, no, I just want to sell conventional. Like, I get it. But 2 things going on. Number 1, 80% of the buyers out there today, around that number in every market, can't get qualified today. And number 2, they all want cash, sure, but what is the backup plan? Well, I'll just stay then. Okay, then I'm motivated. What's the backup plan? Oh, no, I got to sell. Like, I got to do something. Call me in 3 months if it's not sold. So you got to find out their motivation and then just solve for that, timing wise.
Okay. That makes sense.
So where, by when, and what if it doesn't happen? Boom. It's simple 3 questions.
What if it doesn't happen? I think is a really powerful line.
Yeah.
I think this is a really powerful question because it forces them to, kind of get a little bit more vulnerable. And then you can start to really use that to build the rapport and offer your solution as an alternative to.
Yeah. You know what a lot of them say, even the first time you ask that? Oh, no, it will. Of course they think that.
Yeah.
No, it will. So then I got to go, all right, well, hypothetically, Danny, just on a whim, if it didn't sell, what would you do? You just ask it again differently, right?
That makes a lot of sense. Sandwich leases. Sounds tasty. Talk to me about that. I know that you've talked about this a lot. So is that kind of what we were talking about before, where you're leasing out the property that you don't actually own?
One. Yeah, we don't buy it. I said it third because it's my third favorite and third on the pecking order if I'm talking to a seller. Why? I'd rather own for accounting reasons, depreciation and other, right? I'd rather have no clock ticking. But if I think I can help you as a seller, and you don't want to give up the deed and you're not free and clear, I'm going to offer the lease purchase. The word sandwich just means what we were talking about earlier, or arbitrage, you call it too. I'm going to lease purchase your house. I'm going to control it for $10. Our agreements are pre-built with $10 deposit. I'm then going to exit rent to own still. So I'm in the middle. We cloud title, so they can't sell it to Uncle Johnny on a whim, right? They could just sell it off if we didn't cloud title. So we cloud it with a real estate memorandum in California or in our area, notice of option, doesn't matter what they call it. We always do cloud title. And then at the end, when your buyer goes to cash you out, you get that release. You sign off on that release.
Gotcha. For those who are unfamiliar with what that means, right? So what does clouding title mean? Explain that.
It's like putting a lien. That connotation means negative, but you're putting a lien on the property so that if they went to sell it to their cousin tomorrow, the person getting the financing and the person buying, even if they were cash, is going to do a title search and they're going to see there's a notice of option on it and it says it can't be sold. Mm-hmm. We have the property tied up basically.
Yeah. That is protecting you because ultimately the way that you've structured it with them, right, is a lease purchase, right? So you're leasing it for a certain period of time, but you will buy it. Now, why would a seller, just out of curiosity, right? Like, why would someone say, like, I don't want to release title yet? Like, I don't want to sell it yet. What would someone's reasoning for that be?
They're not comfortable with the investor, right? Yeah, I call them. They don't know me for a hole in the wall. I can be great at my scripts, but they might just say, look, I'm not comfortable giving up title. Is there another way we can do it? Now, there are other ways too, contract for deed, land contract, but generally speaking, the lease purchase is simple for a new person to explain to the seller. Yep. Look, I'm going to take over your payments and pay them on your behalf. I'm going to take over maintenance and repairs. And on or before 36 months, you'll get your equity. A seller can get that. Like, that's basic versus getting into a bunch of legal mumbo jumbo, right? You can always change it later when you have rapport. Now, based on your question, it's interesting because you can change this up too. I can put you on a contract with a lease purchase because you don't know me. I can make your payments for 9 months or 12 months. Now you have the warm and fuzzies with me. I have credibility with you. I then call you and I convert that to a sub 2. We do that every year. Like, I'll look at the portfolio and go, we got to call Danny and see if he's ready to sell. So we can do that. We can give you an incentive to do that. We can pay you transfer tax or something.
Yeah, that actually was in the back of my mind. I was like, I wonder if you could convert
it's a good hybrid
purchase
strategy
to a sub 2.
Yep.
Yeah.
Yep.
It's really interesting. Yeah, I could see why someone wouldn't be comfortable, but at the end of the day, if they're not comfortable doing a sale, why would they be comfortable doing a lease purchase?
It's almost like it's the in-between step. You know what I mean? Like, yeah. They couldn't sell for whatever reason in the open market. Our buyer pool is so broad, we can. And so it's a nice marriage.
So let's talk about your community and how this all fits in, right? Because at first it was just you. So how does your community work? Are they all doing their own deals? Are they bringing you deals? You're doing a JV with them? How does that typically?
Combination of what you said. So there's group coaching and then there's one-on-one coaching. There's different experience levels in the company, but they all are revenue sharing models. So they do their own deals, and the rev share is we're tied to them contractually, like a consultant agreement would be, to rev share on the deal. Different rev share percentages depending on what level in the company they're at, but they're all meant to be super interactive, Danny. So if you're brand new and you went to the seminar, which too many people are getting bombarded with these courses and seminars, and then they go in the real world and they go, I didn't know all this happened. So that's why the interactive part of it comes in. So we're getting on the phone with sellers with them. We're getting on the phone with buyers with them. In my son's case, we're doing deals with them. So as the curveballs come up, and they panic, they just have a lifeline. And that's about, in my opinion, the most interactive approach you could do to get them learning, get that learning curve shortened, right? Because in 2 years or a year for some people, they go, okay, I kind of get it. I'll hit you on this high level stuff, but I get it now. Thanks for helping me do my first, 3 or 4, whatever it is. So that's what we do in the community. There's a Slack platform. They all live in there so they can ask each other questions, not just us and the family and the coaches. But so it's pretty interactive and very, very family oriented kind of glue that holds everything together.
Really interesting. So essentially, they, as a part of your community, they're going to be paying Revshare from their investments, and then so it's Revshare, not profit share, correct?
Yeah, you call it either one. I mean, internally we call it profit share. Yeah, you can call it either one.
Yeah. Okay. Interesting. Yeah, that's cool, man. That's a really interesting model. I don't know that I've heard of anyone doing it like that before.
I don't know of anyone at a big level. Somebody might be like I know in the mobile home park space, there's someone doing that. In the apartments, there might be some people tinkering with it, but nobody's in the general creative space. Look, online, you know more than me. You're probably online more than me with social and whatnot. You are people getting bombarded by courses and seminars.
Oh, yeah, it's crazy.
There are all these empty promises. So my biggest challenge, to be honest with you, after how many years I've been doing it, is trying to manage people's expectations when they find us. Because they've been bombarded with get rich quick tomorrow, and they go, "Oh, this takes some time and work." Yeah, that's called normal. So that's my biggest challenge: managing expectations.
Well, and I think especially right now we're in this we're in the guru era, right? And this is a symptom of the market conditions, because the market conditions ruined a lot of the investors, and so they're like, "Well, what can I do now? I know, I'll teach everyone how to fail, like I did." Except they don't tell everyone they failed. They say, I'm the greatest investor in the world, right?
Well, they find deals in their coaching, which kills me. There's a lot of that going on. Look, when I was doing it, when it just kind of happened organically back in like 12-ish, there were like 4 people that I knew of actively in my space. I could name them. I knew them. I knew 2 of them as friends. Now there's probably 200. It's crazy right now.
Yeah, it is. So, Chris, we are kind of running up on time here. I think we got another 5 or so. But I want to see where your head's at in terms of the residential sector right now as a whole. You're on the opposite coast where we're at right now. Residential's getting hammered. I don't know how you guys are doing. I'm assuming it's pretty similar to what we're experiencing over here. It is, and 2 of my coaches
are right. I have one in LA and one in Northern California. So, I mean, we have, in the 80 markets we touch a lot of these markets in between you and I. Yeah. Yeah. So where do you see the residential sector kind of heading over the next couple of years? Like, let's just say 12 to 24 months. What are we looking at here? More pain? What are we thinking? Well, I'm smiling because I don't know, and the billionaires don't know, and the ones that tell you they know don't know, right? And if you and I knew, we wouldn't be on the podcast. We'd be on some island that we just bought.
Very true.
But in my opinion, why I like teaching, especially the beginners of the community residential, is simply that I don't think people are going to stop getting married and stop buying their first house. And, I think there's a base there. And if they stay within the median, within a range around the median, that's a sweet spot. That's one of the reasons I teach, besides the shiny object syndrome, staying in the residential and then branching out later. I don't know. I honestly don't know. Here's what I do know with certainty. Once you learn creative, it really doesn't matter, because with the market's doing, you have the confidence to pivot, in the confidence to know, what pond am I fishing in? Am I fishing in the free and clear or the expired list? Where am I fishing? And you're confident you can create deals, because again, you don't need 50 of these deals a year to make a very healthy living. So that piece I can predict, that once you learn the skill set, nobody can take it from you, and you'll be comfortable in navigating, versus listening to the media telling you when you should buy or not, which is it's crazy, also crazy, because they don't know, and they're just scaring people. And by the way, when they do that, it only helps to create a real estate niche, because people go, oh my gosh, I need a guide, I don't know what to do. No, just stay focused and we'll walk you through it. So I didn't answer you directly because I don't know, and I don't think anyone does, but I do know that you can position yourself to not care.
Yeah, I mean, and especially the way that you kind of structure your deals too, I could see how like the arbitrage matters more than the actual market conditions, right? Because if the numbers make sense, the numbers make sense. It doesn't really matter whether the numbers are the market's up, down, or sideways. Even better if it's down, right? Because if the numbers work now, they're going to work even better when the market turns back around.
Well, yeah, shoot, I bought stuff in 13 on terms. Some of them I kept. I just sold a couple off now. But talk about appreciation. That's the little nutso. But even in a flat market, when I first started, it was great because of the way we structure the deals.
Yeah, it's interesting. Well, Chris, this has been an action-packed half hour. So really glad that we were able to connect here, and really interesting, strategies. Obviously, nothing new, right? Like these are all things that like a lot of other people are doing, but I think the way that you're packaging it makes a lot of sense, and there's a no BS kind of mindset there, which I appreciate. By the way, in the show notes for those who are listening, all of Chris's links, how to learn more about his program, all that good stuff will be found in the description box down below. Chris, in traditional Cool by fashion, before we let you go, we're going to have you leave the audience with one final gold nugget. Take it away.
Let me say this real brief for that, not knowing your audience specifically. 3 quick things. 1, pick a niche. Talk about managing expectations. Pick a niche. I don't care if it's real estate or not, but in the real estate world, pick a niche that you can get behind. Like we're a win-win-win type of transaction. If that's good, good. Number 2, pick someone that's kind of weathered some storms. To our point earlier, not someone that did 3 deals in their coaching now, but they've been through a couple economic cycles and now to get you through it, because you will hit another one. And when I say pick a person, also a person you can get behind, well-rounded. You and I both know people that screw up their life to be successful, like they lost a relationship or they lost a spouse or whatever, just because they wanted to get there. So get back so that you got comfortable with their whole picture. And 3rd is the top one, put the blinders on for 3 to 7 years. That's the top one in real estate. There's a lot of cool niches and everybody runs around for the shiny object. So if you do those 3 things, you'll have success. I know number 3 is easier to say than do, but those things are fail-safe.
I love that. Chris, this has been awesome, man. Wish you the best of luck, and I'm sure this isn't the last time we're going to chat. I'm sure that we'll chat in the future.
Love to.
Yeah, man, this was great. Thank you so much for stopping by.
Awesome. Thanks, buddy.